Alright, bosses and future bosses, welcome back to Boss Economics World. The only place on the internet where we slice through the noise, ignore the political spin, and follow the one thing that never, ever lies, the numbers on the spreadsheet. Today, we're jetting off to the city of light, Paris. But folks, the lights are flickering. On September 13, 2025, the financial wizards at Fitch Ratings took a look at France's national accounts, squinted, and hit the big, red downgrade button. They've knocked the Fifth Republic down from a solid AA to an A+. Now, for those of you not fluent in the arcane language of credit ratings, let me translate. An AA is like your responsible friend who always pays you back, maybe a day or two late. An A+ is your other friend who promises to pay you back, but you know you'll have to chase them for it after they've been through a messy breakup. France is now officially a notch below the Brexit-battered United Kingdom and on par with Belgium. Ouch. That one's gotta sting more than a slap with a wet croissant. But here's the Boss Economics promise: we don't just report the headline. That's for the legacy media amateurs. We peel back the onion, layer by painful layer, to find the real story behind the story. And the story of France's downgrade isn't just about debt. It's a gripping tale of political paralysis, a broken social contract, and a warning shot fired across the bow of the entire Western economic model. So buckle up. We're going from point to surface, from a single ratings change to the systemic cracks it exposes. Let's get the basics out of the way. Why did Fitch pull the trigger? Their statement is crystal clear, and it's not about economic fundamentals in the way you might think. They didn't say French cheese exports are down or that luxury handbag sales have cratered. No, their reasoning was almost entirely political. They cited, increased fragmentation and polarization of domestic politics and instability weakens the political system's capacity to deliver substantial fiscal consolidation. Translation: France's politicians are so busy fighting each other in a perpetual cage match that they can't agree on how to pay the nation's bills. It's like a family arguing about whether to get pizza or Chinese for dinner while the house is on fire. Let's look at the evidence. The article mentions that since the snap elections in mid-2024, France has burned through 3 different governments. 3. In a little over a year. That's not a government, that's a revolving door with a fancy title. President Macron, bless his heart, keeps trying to push through budgets to tackle what has become the largest budget deficit in the entire euro area, but his parliament keeps slapping it down. The latest casualty was the plan to shrink the deficit from an expected 5.4% of GDP this year to 4.6%. For context, the official rulebook for the Eurozone, the Stability and Growth Pact, sets the speed limit at 3%. France isn't just speeding, they're doing donuts in a school zone. This political deadlock isn't just abstract political science, it has a very real, very expensive price tag. Fitch's analysts looked at this mess and concluded that the government's target of getting the deficit below 3% by 2029 is pure fantasy. They project deficits will remain above a whopping 5% of GDP through 2027. Think of it this way: a country's credit rating is a measure of its ability and willingness to pay its debts. France clearly has the ability, it's the world's 7th largest economy. But Fitch is now officially questioning its willingness, not because the French people don't want to, but because their political system is too broken to write the check. Political risk has fully metastasized into sovereign credit risk. Now, let's zoom out. This political instability isn't happening in a vacuum. It's the explosive symptom of a much deeper, chronic illness: France's addiction to public spending. For decades, France has operated under a unique model. It has tried to combine a German-style export-driven, high-value economy with a Scandinavian-style, cradle-to-grave social safety net. The problem is, it hasn't generated Scandinavian levels of social consensus or German levels of fiscal discipline to pay for it. The result is what I call the French paradox: champagne tastes financed on a national credit card with no credit limit. Let's run the numbers, because the spreadsheet never lies. Public spending: as of our 2025 timeline, France's public spending as a percentage of its GDP is hovering around 58%. Let's put that in perspective. The figure for powerhouse Germany is around 48%. The average for the OECD, the club of rich countries, is about 45%. France isn't just an outlier, it's in a league of its own. This isn't just about pensions and healthcare, it's a vast, complex, and politically untouchable ecosystem of subsidies, state-owned enterprises, and public sector employment. National debt: this high spending leads, inevitably, to high debt. While the article doesn't give a specific number, France's debt-to-GDP ratio has been marching steadily upwards. It crossed the 100% mark during the pandemic and has never looked back. As of Q3 2025, we're looking at a mountain of debt totaling approximately 3.3 trillion euros, pushing the debt-to-GDP ratio to a staggering 114%. This isn't Italy or Greece territory yet, but it's far into the red zone for a core European economy. The political battles you see today, the pension reform riots of 2023, the budget collapses of 2024 and 2025, are the inevitable result of this math. Successive governments, from the left and the right, have seen the writing on the wall. They know they need to trim the sails. But every time they try to touch one of these third rail issues, whether it's raising the retirement age by 2 years or cutting a minor subsidy, the streets explode. The yellow vests were just a preview. The French social contract is built on the assumption that these benefits are sacred and untouchable. The problem is, the global economic reality has changed, but the contract hasn't. So, Fitch's downgrade is a formal acknowledgement of this impasse. The markets are saying, we no longer believe you can solve this problem peacefully. Okay, so you might be thinking, tough luck for France, but why should I, a professional in London, New York, or Singapore, care? Because, my friends, France isn't just any country. It is the indispensable, co-founding, beating heart of the European Union and the Eurozone. For decades, the entire European project has been powered by the Franco-German engine. Germany provided the economic horsepower, and France provided the political vision and military muscle. But what happens when half of that engine sputters and coughs black smoke? The bond market canary. The first sign of trouble is always in the bond markets. The article notes that the premium France pays to borrow money compared to super-safe Germany, the infamous spread, has nearly doubled since Macron's ill-fated snap election call. Let's put some hard numbers on that. In early 2024, the spread on the 10-year bond was a sleepy 45 to 50 basis points, 0.45 to 0.50%. As of today, September 13, 2025, it's flirting with 80 basis points. This isn't just a number for traders to gawp at. Every basis point increase on France's multi-trillion euro debt pile means billions more per year that must be spent on interest payments instead of on hospitals, schools, or tax cuts. It's a doom loop. Political instability drives up borrowing costs, which makes the budget deficit worse, which leads to more political fighting over who should bear the pain of cuts. Lather, rinse, repeat. The ECB's nightmare. This puts the European Central Bank, helmed by France's own Christine Lagarde, in an impossible position. During the sovereign debt crisis of 2011 to 2012, the ECB could credibly step in and backstop countries like Italy and Spain. But France is a different beast entirely. It's the second largest economy in the bloc. A true crisis of confidence in French debt would be a systemic event on a scale that could make the Lehman Brothers collapse look like a minor fender bender. If the ECB creates a special program to buy French bonds and push down their borrowing costs, it creates massive moral hazard. It essentially tells French politicians they don't need to get their house in order because the central bank will always bail them out. This would infuriate fiscally prudent countries like Germany and the Netherlands, potentially fracturing the Eurozone. If the ECB doesn't step in, and the spreads continue to widen, we could see a self-fulfilling panic that pushes France towards a genuine crisis. The paralysis in Paris is exporting systemic risk to the entire continent. The Franco-German engine has stalled, and the EU is now adrift, trying to navigate the choppy waters of the war in Ukraine, technological competition with China, and a green energy transition, all without its political co-pilot. Now for the final, and most important, layer of the onion. Let's zoom all the way out. Don't just see this as a French story. See it as a postcard from the future for almost every advanced Western economy. The toxic cocktail of ingredients brewing in France exists everywhere. Massive post-pandemic debt piles. The US, the UK, Italy, Japan, everyone binged on debt to get through COVID. The global debt-to-GDP ratio is at historic highs. 2. Aging demographics. Fewer workers are supporting more and more retirees. This puts immense, non-negotiable pressure on pension and healthcare spending. 3. Political polarization. The rise of social media, populism, and fragmented parliaments has made the kind of broad, consensus-based policymaking needed to tackle these long-term problems nearly impossible. Sound familiar, America? Remember the debt ceiling fiascos? The US got its own Fitch downgrade back in 2023 for precisely this reason, political dysfunction. For the end of free money, for 15 years, central banks kept interest rates near zero. This was the magic painkiller that allowed governments to ignore their structural problems. They could borrow for free to keep the social contract intact. That era is definitively over. Inflation, as we saw in 2022 to 2023, forced central banks to raise rates. The cost of servicing that massive debt pile is now exploding. France is simply the first patient to show acute symptoms because its underlying condition, its enormous state and rigid social model, was the most severe. The UK had its own brief, terrifying glimpse into this future with the Liz Truss mini-budget disaster of 2022, where the bond markets delivered an instant and brutal verdict on unfunded fiscal promises. What's happening in France is a slow-motion version of the Truss crisis. There is a fundamental incompatibility between the promises made to the populace and the mathematical reality of the national balance sheet. For decades, this gap was papered over with cheap debt. Now, the ratings agencies, acting as the world's financial auditors, are flagging it. So, what have we learned? This downgrade of France by Fitch is not the disease. It is a single, flashing red light on a dashboard full of them. The disease is a political system that has become incapable of making difficult choices. It's a social model built for the economic realities of the 1970s struggling to survive in the competitive global landscape of the 2020s. The market's message is cold, but it is clear, your political psychodrama now carries a financial premium. Investor confidence is a fragile thing, and once it's gone, it's incredibly hard to win back. While the article notes that France's corporate balance sheets are strong and there are green shoots in the economy, this is missing the point. A strong private sector cannot thrive long-term when the sovereign it resides in is fiscally and politically unstable. Capital is a coward, it will always flee chaos for stability. The Great Reckoning for Western welfare states is no longer a theoretical debate for economics textbooks. It's happening right now, in real time, on the trading floors of Paris, Frankfurt, and New York. The spreadsheet is finally presenting its invoice for decades of kicking the can down the road. The question for President Macron, for his endless parade of prime ministers, and ultimately, for the French people, is whether they will finally confront this reality. And the question for the rest of us is, are we watching a uniquely French tragedy, or are we just watching the opening act of a play that is coming soon to a country near you? Stay sharp, stay solvent. I'll see you in the next one.